Macro Hive joins us now, fresh back from a trip to New York, so he kind of straddles the Atlantic to give us an idea both in Europe and the United States. What do you think? A, do you think the Fed's done? And if the Fed is done, the yields go higher or lower?
Well, first of all, I don't think the Fed is done. I still think there's a real possibility that they do hike one more time before the end of this year. So I think that's still on the table. Of course, it depends on the data as it unfolds. But, yeah, the U.S. economy overall still is doing quite well. But even if they were not to hike, I do still think that bond yields, the 10-year yield, will continue to go up. Because the story over the last 3 months has not been about Fed policy, are they going to hike one more time or not? It's really been about the long end going up, which in turn is partly due to things like you mentioned, more bond supply, term premium going up, and also real rates going up, which reflects better growth expectations. So I think that's really the big story here.
Well, I'm going to not be offended that you didn't come see me in New York, but whatever. Up to what? If it still moves higher, what does the 10-year then move higher to?
Yeah, next time I will make sure to see you, Alex. This was a sort of a flying visit. In terms of targets, I mean, I'll be looking for a move up to at least 5%, possibly higher, maybe to 5.25. So I do think there's a meaningful move higher. You have to remember, we were stuck at around 4% for a long, long time, and it took us a while to break above that, and now we're at 4.6 or 4.7. But I think the next level is 5. I think that's the direction we're heading in.
What about here in Europe? Bank of England, ECB?
I still think it's a similar story here. It won't be as aggressive as what we see on the US side, but I think in general what's happening is that we had this incredibly unusual period from the global financial crisis up till COVID, where yields were very, very low because of QE, zero rates and so on. That era's gone. So that means that all interest rates, whether it's the Euro area, UK, US, all have to go back to the level of yields they had before the global financial crisis, which is higher than where we are today.
So if that's the case, what does it wind up doing to the economy? Because, okay, if you get rates here over 5, then what does that do to the economy? But our economy is stronger than Europe. So, like, a 3% it may be more damaging to Europe than for the Bund, for example, than it is here for 5. For 5. Did that make sense? Was that a real sentence?
Yes, it does. It does, yeah. It absolutely does make sense. And I think this just adds to the problems that Europe will face going forward. In some sense, what's happening is that because of strong US growth, it's pulling up yields everywhere, which isn't necessarily what Europe needs, because Europe has high energy costs, it has issues with China insofar as China's eating Europe's lunch when it comes to like car production. And in general, European growth has been relatively weak. So high yields for sure will add to weaker growth prospects for Europe. I think there's a currency consequence of that, which is that euro, I think, in the end will head lower from current levels. But this will be a problem for Europe in the end.
Do energy costs stay higher? And what do you think the implications are of what is happening in Israel right now for those energy costs? I guess we don't know yet in many cases.
Yeah, I think in terms of oil, I think generally we're in the oil will stay high type of regime. I think we could head up towards 90, maybe 95. In terms of the conflict that we're seeing in Israel, obviously terrible news. But in order for that to have a meaningful impact on oil, you do need the conflict to broaden out to include Iran and Saudi as well. Yeah. The big oil suppliers in the region. At this stage, it doesn't look like that's going to happen. So for now, I think the conflict itself doesn't add meaningfully either up or down to oil. I think for oil, it's more about Saudi and Russian supply cuts and then China demand on the other side as well.
Well, Bilal, it seems like the real issue is actually gas when it comes to Israel. All the majors share a field with Qatar, which is shared with Iran. So to your point of broadening out, Europe storage is almost full, but I feel like it does bring back the supply shock issue that just sort of elevates inflation just a little bit higher than maybe we were expecting.
Yeah, you're absolutely correct. And in some ways, although crude oil has gone up over the last 3-4 months, nat gas prices have been relatively more subdued. And so this conflict does increase the risk to the upside for nat gas. And that adds to problems for Europe in general. And if you step back to some extent, what we're seeing around the world is that, you have US with strong growth, you have China with weak growth and low inflation, and then you have Europe with a kind of a stagflationary mix with risk to the upside on prices and weak growth. So Europe, in some ways, has the worst mix of stagflation deflationary type mix, and this just adds to that.
So what do I want to own in this environment? You just come out, you've been talking to hedge funds. So what do you think you should be owning right now? What do they think? And are you both on the same page?
We're not necessarily on the same page. I mean, most hedge funds were trying to fight this move up in bond yields because they felt it was too far, too fast, and it will derail the whole economy. My view is I think bond yields can continue to go up, even, and it doesn't necessarily mean growth will fall off the cliff. So my bias is to be short bonds, to be long US dollars. And on the equity side, I'm more neutral on equities. It's not clear to me that equities will necessarily roll over, even if bond yields go up, because US growth is strong. So the reason for US yields going up is a good reason. So it's not necessarily bearish for equities.
So does that mean that stocks and bonds, in essence, are going to move together? And then what do you do with that within the equity market?
Yeah, I think in general, bond yields will go up, means bond sell-off, and equities I think will go more sideways than anything else. So equities are trading at the low end of its range; it may bounce a bit. So I think on equities it's hard to be too clear in terms of direction. One thing I would say is that it's really the larger companies that are doing well; the smaller companies are doing less well. So maybe there will be continued weakness in the small and micro caps.
I'm assuming you're talking about US equities as well.
Correct? Yeah.
More broadly, what about European equities?
Europe, I'd be negative on Europe. I'd be negative. Even on China as well. Japan, I think, is probably the one area where it's still positive from a geographical perspective. But in general, I think it's really a US equity story at the moment.
What about China? You mentioned one issue with China. The latest news today is that they might increase its deficit. I mean, like the market went, oh, okay, maybe some of the miners had a little bit of a run, but the commodity market kind of rolled over right away. What do you think is actually going to come out of China, and when?
It's a good question. I mean, every week we hear some kind of stimulus news. I think in general the trend will be for lower interest rates to try to stimulate consumption, and then more news about more credit to infrastructure and other stimulus programs, and some kind of net fiscal stimulus. The problem is that, whether you're putting the money into new roads or into new factories, they aren't necessarily that productive, so it won't necessarily increase growth that much. What you really need to do is stimulate consumption, and that's the biggest area of weakness for China right now. So my bias is that when you do get these sorts of positive news stories, my bias is to fade them, because I think there is a structural weak China story that's unfolding here, and it's very hard for policymakers really to do much about that right now.
The only asset class I've heard you say anything vaguely positive about, and even that obviously is a fairly balanced opinion, is equities here. You like the dollar.
Yeah.
You don't like treasuries, so you like the dollar and you like US equities. Do I just go all in on those right now? You've talked a lot about cash in the past. Do I continue with that position? How do I, from a tactical point of view, how am I working this?
Yeah, I mean, from a tactical perspective, I think right now, from an asset allocation perspective in general, I still like to be overweight cash, because cash is king in this environment. It's outperformed, it's probably outperformed equities, depending which equity index you looked at this year. It's outperformed bonds as well. So my bias is to always lean in that direction, and then do tactical trades, like be short euro dollar, be short treasuries. On equities, be tactically long US equities right now. So be very tactical around other markets. But from a big picture perspective, I think cash is still king, because we're in this regime change that we're going through in markets, from low interest rate, low inflation, to high interest rate, high inflation. And in those environments, all sorts of strange market moves tend to happen. So you want to preserve your capital.
Bilal, what would make you put that cash to work? What would be the thing?
Yeah, I mean, I think the biggest thing that would change my view in all of this is if the Fed became extremely dovish. So for whatever reason, if the Fed basically said that, look, we think we've defeated inflation, we're getting US CPI data later this week, and let's say it's a low print, which I don't think it necessarily will be. If we get a low print and the Fed says we're done, we're probably going to cut rates now, and then interest rates fall, that would be very bullish for equities in that environment, because that essentially tells you that the Fed cares more about equities than they do about inflation.
Can I say it's great to see you. Thank you very much indeed for coming and seeing us.